Hello, this is Aishwarya. Welcome to my channel. In this video, let's see CBSE Class 11 Accountancy Paper Chapter 1 Part 2. So, we will be covering the following topics in this video. You can take a look at it. Now, we'll jump to the first topic, which is accounting as a source of information. So, we all know accounting is nothing but identifying, measuring, recording and communicating the financial information to the relevant users, right? So definitely accounting will have all the financial information. So every rupee will be recorded. So the users can make whatever decisions they want based on the information, right? So it's a dissemination of information, which means the information is distributed to a large number of crowd. So based on that, they make their relevant decision. So they make important economic decision with the help of the accounting information, like what to produce, when to produce, how much to produce, at what price should you sell, how much laborers or employees should you hire, what will be their salary. All the decisions related to money are the economic decisions that will be taken based on the accounting information. Okay, and then they'll help to predict the future cash flows. Okay, what will be the future money that will come in and go out. So for that, your accounting information will help, and they'll also help to check if the resources are used properly. Okay, if the resources are wasted or they are underutilized, overutilized, all this information can be taken from the accounting information. And then they'll also give details about if your activities are affecting the society, are they polluting, are they harmful, hazardous. All this information will be given by the accounting information you can take. Then comes the role of accountant. So what do? They observe and recognize the financial transactions, and then they measure, they process, they record, and finally, after creating all the necessary reports, they communicate to the users. All these we have seen in detail in the previous video. Then comes the sub-discipline of accounting. So first, let's see what is financial accounting. So financial accounting is nothing but noting down of all the transaction. Every single rupee should be accounted in the books of accounts. So after that, your journal entry, your ledger postings, and then comes the trial balance, trading account, profit loss account, then your balance sheet. All this is nothing but your financial accounting. And then comes the cost accounts. So cost account, so basically you all know cost plus profit is your selling price, right? Cost price plus your profit is your selling price. So in order to determine the selling price, or what is your final pricing at which your product will be sold in the market, you should know the cost price, plus your profit margin will be added to that. So in order to determine this cost price, cost accounting is used. And there is another scenario where the selling price will be fixed by the market. Say this chocolate, you have this 5 rupee dairy milk. Okay, so you can't sell the product more than 5 rupees. So in order to make 1 rupee profit on it, I say the cost should not be more than 4 rupees, right? So I have to adjust my cost in such a way that I should not be incurring more than 4 rupees for that particular product. So there I will use all the cost accounting techniques. Okay. Then comes the management accounting. So management accounting will take information from financial accounting and cost accounting to make specific decisions. So whatever decision they want to make, they'll take related informations to that decision from these two, and then they will prepare a report or do some calculations and come to a conclusion. That is the management accounting. We'll see that in detail. So in order to prepare budget and assess profit, management accounting will be used. And then to know the pricing and to decide on capital expenditure. Capital expenditure is nothing but spending on assets that will benefit or give value for more than a year. Okay, supposing I buy a machinery, the machinery I will use it for more than a year, so that will be capital expenditure. Usually capital expenditures are heavy expenditure, so in order to make such decisions, management accounting will be used. Okay, then to uh, determine what will be the future sales and to see the cash flow, all that is again a part of management accounting. Then to design on the manpower and what to purchase, how much to purchase, when to purchase, again forms part of management accounting. Then your social and environmental responsibility data, uh, you have to see if your products or service is not harming the environment or the people's health. So all check will be done by the management accounting. Then there are few more types of accounting, like human resource accounting is nothing but the employee is treated as an asset of the organization and they are valued. In social accounting, again they measure the impact on the society and environment. Responsibility accounting is nothing but tracking the performance of the organization by, they'll do it by all the departments, various departments, it will be tracked. So that's the responsibility accounting. And then comes the qualitative characteristics of accounting information. So whatever we've seen so far is the quantitative characteristics. Okay, so we've all spoken about numbers, only if it is measurable it has to be recorded and all that. Now we'll see how the reports are really of a good quality. If they satisfy the following conditions, then the accounting report is said to be of good quality. Okay, so this flowchart is from the textbook. Who uses the accounting information? The decision makers, whoever it may be. It might be the owners, it might be your managers, it might be the prospective investors, anybody. So they will look at it and make some decisions on their activity towards the business. So first, the report should be understandable. So whatever the accountant is trying to communicate, the receiver of the information should also receive that information in the same sense, and it should be easily understandable. That is when the report is said to make some sense. If he is trying to communicate something and if the other person is getting the wrong information, then the understandability factor will not be there. So we have to ensure that the accounting information is presented in such a way that the receiver is able to understand it properly. Then decision usefulness. So supposing the manager wants to make a decision based on the accounting information, so he will require some numbers. So the accounting information must provide all the necessary numbers for him to make that particular decision. If he doesn't get the information from the accounting reports or whatever, then he can't make such decision, then it is of no use. So the accounting reports should have all the information to make the decisions. The accounting information should be relevant. So relevant, it should dictate all the value should be specified clearly, be it purchase, sales, or your expenditure towards rent, salary, tax, everything should be given clearly, and it should be in such a way that you should be able to give a feedback towards that. And then the timeliness. So timeliness here, I mean, it should pertain to a particular timeline and all the transactions should be recorded in a chronological order. Then comes reliability, where the accounting information should be very much reliable. Okay, it should be free from errors, bias, no transaction should have been missed, because looking at the figures, I believe this is what has happened. Okay, if the information is not reliable, then you cannot trust the report that is being presented. Then it should be verifiable. So it should have supporting documents. For example, if there is any sales that is made, there should be a supporting invoice for that. Okay, where you can cross verify the recordings. Then it should be faithfulness, it should be trustworthy, because just looking at the report, I trust that it has been prepared with utmost care, taking all the transactions into account without error. So that faithfulness should be there. And neutrality, there should not be any bias. Okay, you should not favor anybody, it should be prepared with a neutral mindset. Then the report should be comparability, no sorry comparable. Comparable here I mean, so I prepare a report for the current accounting year, it should also be comparable with the previous year. So I should not be using some differentiation methods last year and change my method this year, then I cannot compare. There should be consistency in the way I prepare the reports so that I can compare. And also the report should be in such a way that I can compare with the other companies of the same industry. So accordingly, the report should be according to the accounting standards. Let's see the detail what is given. Yes, first we saw reliability. As I told you, it should be free from errors and bias. Okay, it should faithfully represent the transactions. All the transaction has to be recorded. Nothing should be missed. If something is missed, then your entire profit calculation, tax, everything will go wrong. There will be a chaos on everything. So everything has to be recorded, and it should be verifiable, credible, neutral, and all that. Then relevance, so it should be, the information must be timely, it should aid future prediction. So looking at the report, I should be able to predict, so what will happen, will this company do good or do better in the future, and I should be able to give a feedback on that. Okay, and then comes understandability and comparability. As I told you, whatever the accountant is trying to present, the receiver also should receive it in the same way as it is intended, and without compromising on the relevance and reliability. This is most important. There should not be any compromise in the way it is prepared, which is the previous 2 points. Then comes comparability. So your accounting information, the final reports should be comparable. So they should be consistent in the preparation, and they should be single unit of measurement. So if you are using rupees, you have to use rupees. If you are measuring it in lakhs, it should be in lakhs. Okay, so that will help easy comparison. It should be on a common period. You can't compare a daily report with a monthly report. Okay, if you are comparing a daily report, you have to compare with another daily report. On the reporting format should also be same. That is when it will help comparisons with other companies' report in the same industry. So with these, we come to the end of this video. The same video is also explained in Tamil. I'll give the link in the description. In case of any doubt, you can mention in the comment section. And if you like it, share it and subscribe the channel. Thank you so much. See you in the next video. Bye.